A dead cross is a bearish signal that only takes place when the longer moving average is already turning down by the time that the shorter moving average crosses it. That produces a dead cross, a sell signal that is extremely reliable. A golden cross only exists when the longer moving average is already turning up when the shorter moving average crosses it. This giving a golden cross a buy signal that is extremely reliable. For example, here is the daily chart of euro using the 10 and 50 combination. You can see how the first cross was not a dead cross because the 50 right here was still flat, maybe even pointing up. But the next cross had the 50 already steeply pointing down, and that made it deadly. The signal cut a large portion of the downtrend back from January all the way here to September. The dead cross is the type of signals you want to look for and take every single time you spot it. And here you can see an example of the golden cross in the dollar yen. In this example, you can also see why it is not recommendable to take double cross signals when the slow moving average is pointing in the opposite direction of the signal, such as in this particular case. You can see how the shorter moving average crossed below it, but the longer moving average was still pointing up. That is not a signal that you want to take. The ideal signal is precisely when the longer term moving average is already pointing up by the time that this shorter term moving average crosses it to the upside. That is the golden cross.